Okay guys, welcome back. This is part 3, which I hope is the last part. I hope so. I don't know. Okay, so let's do it. We were at 31st December 20.1. Okay, now it means we are moving, and then we have the movement for now for obviously 20.2. Okay, let's go. Let's go to 20.2. Here's our 20.2. Temporal differences. It's a taxable temporal difference of 25,000, which we need to multiply with 28%. 25,000 multiplied by 28%, which would give you 7,000. Okay, guys, it's a taxable temporal difference, and we said taxable temporal differences are positive. Okay, that's the first step. And then the second step, what you need to do is you need to add the two, because they are all positive. They should give you 21,000 rand. Okay, and then we move to this part in here. Okay, so what is happening here is for 20.2 we have an assessed loss of 100,000 rand. Remember, this is our taxable temporal difference. I want to check something. This is our taxable where is this thing? Taxable income, and then assessed losses brought forward, and then we have 100,000 rand, which is our assessed loss for this year. Obviously 100,000 multiplied by 28%, it should give you 28,000. What that means now is that we have a deferred tax asset arising from assessed losses of 28,000 rand. Okay, that 28,000 rand obviously it has to be provided for to the extent of a taxable temporal difference of 21,000. It means we need to provide to the extent of 21,000 rand. Okay, so if we provide to the extent of 21,000 rand, what does that mean? It means how much have we not provided for this year? Because obviously in here we need to have minus 7,000 to get to here, Okay, so now it means what has not been provided for. It's 28,000 minus 21,000, which is obviously which should obviously be, let's do the calculation. You need to have minus 16,800 plus minus 16,800 plus that. And okay, so if we say that I want us to do it like this. If we say we had a deferred tax asset of 10,800, right? That was not provided for, and we have provided up until 21,000. It means what is not has been what is not provided for at this stage, it's 30,800 minus this, which should give you 9.8. Okay, obviously from here to here we've unprovided for 7,000. Okay, now you need to know the signs. You need to know what they mean. Okay, we are moving from 16.8 to 9.8. It means our unprovided for has decreased by 7.8 to 9.8. Okay, because unprovided for it's negative, just know that. Okay, wonderful. And then we know this and this should give you 0. This and this should give you 0. Okay, so it means we have no movement for 20.2. okay, now let's go to, because this was the movement for 20.2, this means it is the 1st December 20.2. okay, it's the 1st December 20.2. now we need to have the movement movement for 20.3. Now let's look at 20.3. Here's 20.3. We have a temporal difference of how much? Of 20,000. Obviously, 20,000 multiplied by 28%, it should give you 5.6. This is a deductible temporal difference, and we said temporal differences are what? Are negative. So we have that negative 5.6. Okay, and the second step, as we know, we need to sum these two, and this minus that should give you 15.4, which is positive. Okay, now carefully now. Okay, let's talk about this. We have 20.3. We made a taxable income of 210. We brought forward 100, and we made 110,000 rand taxable income for the year. Okay, what this means, it means for this year, if we've made a taxable income of 110, okay, let me quickly check something. Multiply by, obviously, okay, if we've made a taxable income of 110 and multiply by 28%, obviously it gives you 30.8. Remember, we had unprovided for 30.8. It means now by this time, it means now by this time we don't have any unprovided for, and we don't have any that is provided for this year, because obviously now we are in the money, we are making the profits, and we are about to recognize our deferred tax liability. So obviously this should result to 15.4. okay, 15.4, obviously. Let's go. 15.4. And to get to here, it means we need to have I think I've done something in here. Okay. Oh, okay, by the way, this should be plus 9.8 to get to here, and this should be plus 21,000 to get, just to check if we are still on the right track. Let's do minus 5.6 plus 21,000 and see. Okay, yeah, it gives us 15.4. Then it means we are still on the right track. Okay, this is where our table ends. Now I need to explain what this table means to you guys. Okay, wonderful. This is the balance. Let's highlight it. Let's highlight the balances with this color. Balances with this color. Balances with this color. Balances. Okay, and then let's highlight the movements. Let's highlight the movements with yellow. Okay, cool. You know what this means is, it means that for year ended 20.0, you disclose a deferred tax liability of 16.8. okay, for year ended 20.1, you recognize or disclose a deferred tax liability or asset of 0. 20.2, same thing, you have no deferred tax asset or liability. And then now comes 20.3. In your financial statements balance sheet, you need to have a deferred tax liability of 15.4. This is what this these balances mean. Okay, but now let's look at yellow. For 20.1, what is happening here is that these are the movements. Okay, these are the movements. So for 20.1 financial year, we need to have in our expenses, because this was a reversal of a deferred tax liability, we need to have a deferred tax income of 16.8. Let's come here to our disclosure. Remember, okay, let's start here. For 20.1, we didn't have any current tax, so let's have a current tax of nil. Okay, and also for 20.2, the current tax was actually nil. Okay, but for 20.1, what is the deferred tax expense or deferred tax income? Here is it. For 20.1, the movement is 16.8, which is the deferred tax income. Then you need to come here, okay, and put through your deferred tax income of 16.8. Okay, and then for 20.2, we don't have any movement, which is 0. Now let's go to 20.2. We have 0 movement for deferred tax. Okay, now let's go to 20.3. 20.3, we have a deferred tax we have a current tax expense of 30,800. Of 30,800. Now let's look at the deferred tax. What is happening with the deferred tax? So we have a movement of 15.4, which means we have a debit to deferred tax expense and a credit to deferred tax liability of 15.4. So this is a deferred tax expense for 20.3. We come put it here. A deferred tax expense of how much? Even forgot. How much was it? It's 15.4. Okay, 15.4. So after this, what we need to do is we need to now add those two things together. It should give you a 46,200, and this should give you 0, and this should give you minus 16.8. So now let's talk about this. Your income statement. Okay, well, in your income statement, your tax expense for 20.1 is going to be a tax income of 16.8. For 20.2, you don't have a tax expense line item. For 20.3, you have a tax expense of 46,800. Did you notice that we got all these figures from this table? From this table, if you have assessed losses, it becomes very important. Okay, so if you've done, obviously we don't have under provisions, over provisions, whatever, we don't have them. Okay, now let's move to the rate reconciliation, which is our last thing for IAS 12. Obviously, profit before tax, we know, which is accounting profit before tax, it's 120,000. We need to multiply that. We need to multiply that by 28% times 120,000 rand. Then we have 33,600. Okay, just be careful. Okay, we have 20.1, we have 20.2, we need 20.3, we need 20.3. Let's delete this, let's delete this. Actually, no, this is 20.3. This should be 20.2, and in here we should be having 20. In here we should be having 20.1. Okay, now let's go profit before tax. We said that 120,000 multiplied by 20%, it should give you 33,600. Because this is a loss, it gives us a tax income, okay, of 33,600. Okay, tax income of 33,600. Okay, remember it was negative, so it should be positive. Okay, and then for we have 35,000. Remember, again, it is positive, which means when it goes there, it should be negative. 28% of 85,000, it should give you how much? A negative 9.8. I hope I'm right. And then for 20.3, again we have 190. At 190, which was positive, remember? It was 53,200, which has to be negative. Okay, now the exempt income, non-deductible, whatever, let's not mind them for now, because those were not the focus of this class, obviously. Okay, so with the rate change, we don't have it, but I've explained how it works, but we don't have it for this question. Here is where we are coming now. Unprovided losses. Remember, I said this part, it's the disclosure part, which means it's the part that goes to your rate reconciliation. Unprovided assessed losses. Let's go. Remember, we don't take the balances of these things, we take the movements. Okay, we take the movements. Okay, we take the movements. So for 20.1, here's our movement, 16.8, as it is 16.8. For 20.2, plus 7,000 plus 7,000. For 20.3, plus 9.8. Okay, plus 9.8. And then your disclosure is proper and done. Okay, so guys, thank you for watching the video, and thank you for subscribing to the channel. Please don't forget to tell other friends to subscribe to the channel. If you have any question for me, feel free to drop a comment and tell me what you need help with, or rather send me an email, and I'll be happy to help you guys. Thank you very much.